most of us don't like it when interest rates rise, right? Because our mortgages get more expensive, economy seems to slow down, and in general, it's seen as a bad thing. Not everyone though. Those living on a fixed income, those living on term deposits, for example, might not mind when interest rates go up. Yeah. Now, interest rates go up for a number of reasons, but the most visible reason why is because central banks put them up or put them down. So maybe the question is, well, why do they do this? Or why even do we allow them to do this? You know, I'm a free market guy. I think that markets should set prices and rates. So why do we allow central banks to set rates? And how do they do this? Well, to understand this, we need to firstly just understand the mechanism by which central banks manipulate cash rates. And to understand this, we need to understand that the central bank acts generally as the bank of banks, acts as, in particular, the lender of last resort to banks. And when does this come in handy? Well, every night when all the transactions are finished, banks close, there's likely to be between banks balances. What I mean here is during the day, maybe my bank sent your bank some money because I paid you some money, yeah? So at the end of the day, my bank needs to pay money to your bank. And this happens hundreds of thousands of times over, millions of times over during a day. And at the end of the day, banks might have surpluses or deficits with different banks. And on aggregate or net, let's say, they might have net overall surplus or deficit with external banks. So those banks need to get that money. And so we go to the interbank market, whereby banks look to settle their overnight imbalances. Now, you could do this one-on-one with each of the different banks, yeah? So I owe that bank some money, that bank owes me some money, and you figure it all out. But the easier and more efficient approach is to use your reserve bank account. So if you have surplus, you can put that into your reserve account, or if you need money, you can borrow. That is, the central bank in this regards acts kind of like a intermediary that nets off, helps banks net off all that's owed. Now, sometimes some banks that have a surplus want to keep that surplus, and they might end up with a net deficit. And as the lender of last resort, that's where the central bank can step in and say, yes, we'll lend you this money overnight. The money that you're short, we'll give you that overnight, and you'll have to repay it back tomorrow, for example. So that's how the central bank can interact with the banking system, and in particular, interact with cash rates. They can take surplus monies, that is, you can invest deposits or invest into your reserve account, or you can have a deficit. You can borrow from your reserve account. And the rate at which that will occur is the rate that the central bank targets. And to ensure that supply meets demand in this regards, they offer the excess liquidity or take out liquidity from the system, so that the end price that this transact happen at is the overnight cash rate. And so the next question is, well, they can manipulate this cash rate through adding liquidity or taking liquidity out of the system, but do we want them to? So maybe getting a little bit philosophical here, but is there a good reason for them to enter into the market and do this? If they didn't add the necessary liquidity or take out liquidity, then just simply the supply and demand of money between the banks would lead to a overnight cash rate, except for overnight.
Now, if you're a bit of a finance nerd like me, why don't you check out my Substack? There's a link in the description, and here you'll find additional concept notes, unedited videos, community chats, and much more. See you next time.